Hi there everybody and welcome back to another stock analysis video. Today we are going to be analyzing the company Activision Blizzard. Company that I've actually done in the past, and they've actually had a recent merger when it comes to Microsoft. So let's analyze this company, especially since their earnings are coming out as of Monday before open. Let's analyze this company, see what's going on with Microsoft, and come up with a target share price to see what we might want to buy this company at. So with that said, let's get started with this video. Now before we head into the actual numbers, something to definitely point out is that Microsoft as of January 18th wanted to acquire Activision Blizzard to bring the joy and community of gaming to everyone across every device. Essentially, they want to buy Activision Blizzard and bring their games solely to their Xbox. Right here it says Microsoft will acquire Activision Blizzard for $95 per share in an all-cash transaction valued at $68.7 billion. So essentially $69 billion. If we take a look at Activision Blizzard's current stock price, we're at $78.61 with a market cap of $61.61 billion. So just then and there, if you already have this company, or after seeing this video and let's say that their fundamentals actually look good, and you buy this company at the current share price, you are essentially buying this company and saying that Microsoft will be able to give you the difference of which that you buy it at. So if you pay for this company's market cap of $61 billion, which is currently at, and Microsoft buys it at $68.7 billion, it's actually $69 billion, Microsoft is essentially paying you $8 billion for this acquisition. So with that said, let's actually head over into now some of the fundamentals when it comes to this company, starting off of course with the dividend summary. Dividend yield of 0.6%, which ends up being 47 cents per share for an annual payout of 47 cents. This pretty much is telling me that, well, they do pay one dividend a year, and as you can see right here, the dividend frequency is annually, so only 47 cents, one payment a year. It could be a little bit better, but then again, you know, it's either 47 cents one time a year or 47 cents divided by 4. At the end of the day, you're still getting paid no matter what. Payout ratio is 12.63%, which is again really good. Anything double digits is amazing. 5-year CAGR, which is the 5-year growth rate, at 9.39%. Normally, I would argue that this would be significantly better, but then again, this company solely does gaming and software. Seeing that they only pay out 47 cents and one time, this is not surprising in the slightest. What is surprising though is that their dividend growth is 0 years. And the reason for this is because if we take a look at their dividend history max chart, we could see that they actually did not increase their dividend from 2021 to 2022, keeping it the same thing as 47 cents. So it's not like they cut their dividend. However, when it comes to dividend play, this could definitely be significantly better. Ex-dividend date passed as of April 13th. Payout date is going to be on May 6th. And as I said, they pay their dividends annually. Coming over here now to the calculator, we got the ticker symbol of ATVI, market cap of $61.4 billion, PE of 22.83. So at the current share price of $78.61, this is pretty much just telling me that according to their earnings, this is a little bit overvalued. However, guys, something to note again is that Microsoft is acquiring this company at a significantly higher valuation than $78.61. So take that into account that if you were to buy this company now, Microsoft would essentially pay you the difference. Now, coming over here to their dividends, we do know that they pay one dividend a year, as we just saw, 47 cents per share, which comes out to be $366 million in dividends being paid out every single year. Now, after this dividend is paid, in regards to the 5-year average free cash flow, they're still left with a whopping $1.62 billion left, which is a payout ratio in regards to their cash flow of 18.42%. Which is really healthy. And now that Microsoft is going to acquire them, they're actually going to get significantly more cash flow than this, making the payout ratio significantly lower. Coming over here to the fundamentals, starting off with a net income of 5 years ago of $273 million to 1 year ago of almost $2.7 billion, increase of 889%. Now, this is a huge increase, guys. And I would argue that definitely the big outlier here is 2 years ago and 1 year ago. Well, what happened was 2 years ago, COVID happened. Everybody was staying at home. And what were people doing? Well, probably playing video games, which explains why a company like this went from $1.5 billion, actually a decrease from 4 years ago to 3 years ago, going from $1.85 billion to $1.5 billion, and a massive increase up to $2.2 billion. Again, People were staying home. People were probably live streaming. That's something else that people tended to do. They started making videos. They started gaming. They started putting stuff on YouTube, meaning that a company like this that makes video games, they probably got a nice boost as well, which explains why from 2 years ago to 1 year ago, they just completely shot up in their net income. Coming over here to the free cash flow, we see something very, very similar. 5 years ago of $2.1 billion to 1 year ago of $2.3 billion. Increase of 13% with an average 5-year free cash flow of $1.9 billion, almost $2 billion, honestly. Now, we see something very, very similar, whereas 2 years ago and 1 year ago, they completely shot up even higher than that of what they did 5 years ago. 4 years ago and 3 years ago, they did go down. I don't necessarily know why, but again, because of COVID, because people were staying at home, people 2 years ago and 1 year ago, they decided to play more video games, and explains why this free cash flow actually went up. Looking over here to the revenue now, 5 years ago of $7 billion to 1 year ago of $8.8 billion, increase of almost 25.5%, which is really, really solid. And actually, this graph is very, very steadily. The one issue here that I see is 3 years ago, they went down to $6.5 billion, and from 4 years ago, they had $7.5 billion. So they went down a little bit, you know, they went down by around $1 billion from 4 to 3 years ago. I don't necessarily know what caused this, but nonetheless, if you were to just take this number out as an outlier, then this graph would be very, very steadily going up. Coming over here now to the total assets minus the total liabilities. This metric tells us if the company were to liquidate all of their assets, would they be able to cover their liabilities, and how much money would they have after doing so. Currently, if Activision were to do this, then they would have $10 billion in total assets minus total liabilities. And for what it's worth, guys, they have been positive every single year within the past 5 years and increasing their assets minus the liabilities, which is actually really, really good. Average total assets is around $9.3 billion. Average total liabilities around $2.9 billion. Average assets minus the average liabilities, we have around $6.4 billion. Now, looking at the shares outstanding, a metric that tells you whether or not the company is diluting you as the investor. You want this number to be coming down, not up. Now, as we can see right here, when it comes to Activision, they are diluting you slightly, going from 757.5 million shares to 779.1 million shares. On the 5 years, this is an increase of almost 3% at 2.85%. And from the previous year to the current year, we are looking at 2 years ago to 1 year ago, they increased it almost 2/3%. Now, is this a big increase? No, I don't necessarily think so. Anything between 1 to 5%, I see it as the company deciding, you know what, our stock price is very, very high. Instead of taking on debt, let's just issue shares. It's no harm foul to us. We barely pay out a dividend, right? We can definitely afford to issue more shares and pay out more of this dividend. So let's just issue more shares instead of taking on debt. So even though this is an increase, I don't necessarily see it as a bad thing. In my personal opinion, they did the right thing in issuing shares rather than taking on debt. And lastly, we got the cash and equivalents. Currently, guys, they have around $10.4 billion in cash equivalents with an average cash equivalents of $7.4 billion. Now let's make some assumptions, low, median, high, using 3 different factors: revenue growth, projected share buyback, and the required rate of return. For the revenue growth, guys, I'm going to use Seeking Alpha's growth tab, looking at the revenue growth year over year and the revenue growth forward, and coming up with a conservative assumption between those. Predicted share buyback, I'm going to be using the graph that we just saw based on the shares outstanding, and the required rate of return, keep it flat, 10% across all assumptions to match the S&P 500. Now, doing a discounted free cash flow on this company, I'm going to say, for my lowest assumption, a growth of 5%, projected share buyback of -3%. This means that they are going to issue shares at -3%. And what we just saw is that with the past 5 years, they have increased their shares outstanding by a little less than 3%. So I'm just going to say that they're going to issue 3% in shares for the next 4 years. In doing so, we get a target share price of $81.90. For my median assumption, I'm going to assume a growth of 6%, predicted share buyback of -2%. This comes out to be $85.61. And lastly, for my highest assumption, a growth of 7%, projected share buyback of -1%. This comes out to be $89.47. Now let's adjust for debt. And the way we do this is we take the cash equivalents and we add the net debt. If they have more debt than cash, then obviously this number comes down. If they have more cash than debt, then this number comes up. As you can see, this number does come up to $94.88 for my lowest assumption. For my median assumption, $98.73, and for my highest assumption, it is $102.72. Now let's add a margin of safety, 5, 10, and 50%, just because you don't want to overpay for something. The more you pay for something today, the less returns you're going to have in the future. So adding this margin of safety for my lowest assumption, I personally would like to buy between $80.65 to $90.14 for my media assumption, around $84 all the way up to $93.79, and for my highest assumption between $87.31 to $97.58. Guys, as it stands, the current share price is $78.61. So pretty much anywhere that you look at this is a pretty good looking stock to buy at the current share price because, well, every single assumption that I have made is significantly higher than this share price. Now, these target share prices are based off of my assumptions, as you see right here. As I always say, these are just my assumptions, guys. I have this calculator available for free. Anybody could have it. I also have my book value calculator as well. It's in my calculator playlist. All the videos are there and how to use it, what to input, where to find them, everything is there. The links are also there in the description below. Get this calculator, you make your own assumptions, right? You can pretty much change all of these numbers to whatever you want. For example, if you think that I am wrong, maybe Activision will grow at 15% now that Microsoft is going to acquire it and that they're going to buy back shares at what, 5% or something. Then you want to keep the required rate of return the same at 10%. Then you can pretty much just see how drastically these numbers change based on the assumptions that you essentially put here. So this really all depends up to you. This is not financial advice. As I always say in every single video, you should make your own assumptions. These are just mine. All I ask for in return, guys, for these two calculators, and I also have my dividend tracking sheet as well and how to set it up. All I'm asking for in return, guys, is like, subscribe, comment. It really does help. All I'm asking for. We up to what, 528 subscribers. Thank you very much. Would love to reach 1,000 by the end of the year. That would be absolutely incredible. Tell your friends, you know, if you have people that want to get into investing and that they want to process through a fundamental basis, please tell them to look up Fatal Money. It's my channel and help me grow. It's really all I'm asking for. Now, looking at the dividends at the current share price, since this company does pay a dividend, let's assume that we take the average US income, $68,703, bring it to the monthly is $5,725. At the current annual dividends per share, how much money would this company actually pay you if you were to put in 1 month's income at this average US income per year? Well, this would buy you around 72.83 shares, which would actually come out to be $34.23 annually, with a quarterly dividend of $8.56 and a monthly dividend essentially of $2.85. So as it stands, this company is not that good when it comes to dividends. As I said, they didn't increase it from 2021 to 2022, and you know, $5,000 for $34 a year, it's really not efficient in my personal opinion. There are better companies out there to put money in when it comes to a dividend perspective. All in all, guys, when it comes to Activision, again, this is a company that really just depends up to you. I'm personally not going to buy it because it does not match my investing strategy. However, if you guys think that, you know, Microsoft is paying for this company at a significantly higher valuation than the current share price. So if you buy it right now, right, assuming that Microsoft actually buys it at the share price that they actually want to buy it at, then Microsoft is essentially paying you for the difference if you were to buy it at the current share price, right? So it really is up to you. Me personally, I'm going to skip on this. I would rather hold other companies that pay a higher dividend and other companies that are significantly way more growth oriented. That pretty much does it for this video. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. As I said, you can follow me on my new tech sites of BitChute, Odyssey, and Rumble. All links in the description below. Have a Let's Play channel as well. Link is also in the description. So if you want to follow me, you can follow me there too. With that said, peace out and be on the lookout for the next stock analysis video. Which, by the way, because there are so many big companies and important companies coming out with earnings this week, I'm going to be doing as many as I can, and I'm going to try to put more than one video a day. So be on the lookout for that, and probably within a couple hours of me posting this video, you will see another one. Also, guys, I am going to try and record as many videos as I can as of April 24th. So when the company actually has earnings, these share prices might actually be significantly different. So, you know, just understand that I'm not recording this when the company actually has earnings. I'm recording this significantly days before. So with that said, peace out, and I will see you all next time.